Juliana was asking about how do you come up with a great story? And so I told her it was just the first week, so just take it easy. But most new analysts make the mistake of talking all about the past. They may dazzle you with their in-depth knowledge of everything that happened in the company's past, but the past already happened and it's likely all in the price. Valuation is all about the future. Now, you want to present evidence. You want to support your conclusion with evidence so that the listener finds them credible. And you want to represent the interests of the listener or the reader by being critical, objective, and independent. You're an outsider analyzing Toyota or TSMC, and you're representing, let's say, an outside investor. So the first thing is, what's your main point? What is the point that is going to support your conclusion? Your conclusion is whether it's a buy or a sell. So it could be that the stock's cheap, or you expect growth to explode, or price should double, or the economy is going to bounce back. The next thing is evidence. You want to appeal to the logical left brain people. What's your evidence? The stock is cheap? Well, it's trading on 10 times PE. Expect growth to explode. The newest contract should add $100 million in profit. Price should double. If it re-rates to only 20% of the industry average, price should double. An economy is going to bounce back. It's bounced back after each of the past crashes. These are examples of how you can support your point with evidence. Now, I wanted to talk briefly about Standard 1B, independence and objectivity in the CFA codes and standard. The standard says that members and candidates must use reasonable care and judgment to achieve and maintain independence and objectivity in their professional activity. I love being objective. Top analysts are independent and objective. So remember, you do not represent the company. You're an outside analyst looking at the company. So you don't want to be a mouthpiece of the company, whether it's whatever the company says, you're not representing the company. Now, what they say may make sense and you agree with it, that's fine. Do your own research. Now let's look at some examples of good stories. Here's a story that we did on Nike. There's 3 things to know about this company. Digital expansion bears fruit, driving top line growth. Re-engineering retail business could enhance margin further, and competitive position means profits beat those of its biggest rival. So there's 38 analysts covering the company at the time that we did this, and there was upside of 29%. It was a buy. The PE ratio was 29 times and dividend was a very small 0.7. My estimate at the time of value was at 112, which meant a sell. Now let's talk about the digital expansion. Digital sales already make up about 25% of Nike's revenue in 2021 compared to 5% in 2014. Compared to its competitors, Nike already expanded early in its digital channels, which delivered high growth. Especially during the pandemic, its early efforts paid off big time. The new normal could continue to push digital sales further up. Now here we can see that digital penetration is part of its strategy shift. You can see the app on the other side. The company increasingly focuses on direct-to-consumer sales. Under its campaign Nike Direct, it aims to promote its own retail stores and expand its online platform. The objective is to create a mono-brand experience and reduce the reliance on wholesalers. Why? Because as a result, Nike can yield a higher average selling price per shoe. So how did I incorporate this into my forecast? Well, I broke the revenue down into digital and non-digital as they gave it. And I said, expanding digital sales comprises the key growth driver in the future. It's going to go from 10.6 to 12.7, all the way up to 18.3. That's much faster than what's happening in non-digital. Now, re-engineering retail business could enhance margin further. In 2021, Nike's direct sales make up 35% of total revenue compared to 26% in 2017. And by 2005, the company aims to ramp up the contribution of direct sales to 50%. And remember, wholesale partners tend to offer large discounts when reselling, and that devalues the brand. The shift also enables Nike to regain price control of its products. Now, cutting out the middlemen should result in a margin expansion. Focusing on that direct sales could enhance Nike's gross margin by 2 percentage points over the near term and further potential over the long run. This strategy makes sense as the company is, unlike its initial growth stage, is no longer completely dependent on wholesalers to raise brand awareness. So how did I incorporate this into my story? I looked at the number of retail stores and I said scarcity creates demand. Nike continues to reduce its own retail stores, making its products more desirable. The increasing management efforts to shift to direct sales should be rewarded with a significant gross margin expansion. You can see my forecast is that gross margin is going to go from 44.9 to 46 in 2022, and then up to 46.5 by 2024. Then the competitive position means profits beat those of best rivals. Nike's 5-year revenue, 6.8% revenue CAGR was 4 times higher than the second largest sports giant, Adidas. ROE of 37% at Nike clearly beat Adidas. And Nike's profit is remarkably high. Of course, the risk is that it could only fall from here. So it's important to watch whether it can maintain it. Meanwhile, Adidas has room to improve. Now, what is the role of cash in invested capital? Here we can see that I looked at 19 years of data of the average of all companies, about 12,000 companies. And I saw the amount of debt and equity and combined those to say that's the invested capital. And then I took away the cash and long-term investments because cash is something that can be used to pay down debt, and long-term investments are not operating assets. And now I came up with these non-operating assets of 5.7, which means the operating invested capital goes to 21. So invested capital 26.7, operating invested capital at 21. And then we can do that, for instance, for the sector, as in the consumer discretionary sector, and we can do that for the company so we understand what's happening. So massive value creation is already priced in. In 2021, Nike delivered an astonishing ROIC of 69% and could maintain the heightened level over the short run. I forecast that Nike can grow its extreme level of ROIC over time as it generates a lot of cash. Still, it does not lead to any upside, which makes me assume that the consensus is too bullish about Nike's growth prospects. So here you can see the ROE is kind of down, right? But the ROIC is going up. What's causing that? You can see the divergence in the red line and the green line. That has all to do about the cash that's on the balance sheet. Because remember, when we calculate return on invested capital, we reduce the invested capital by the amount of cash. And so that's why the ROIC goes up really high. So let's review our Nike story. Digital expansion bears fruit, driving top line growth. Re-engineering retail business could enhance margin further, and competitive position means profit beat those of biggest rivals. Now, are there any questions or comments before I go on to some bad stories?
Here are 3 reasons why you should join the Valuation Masterclass Bootcamp. First, you'll get practical experience in valuation and sharpen your analytical skills by applying finance theories to real-world problems. Second, you will learn the valuation frameworks, tools, and techniques I have developed and used over the past 30 years that got me voted #1 analyst in Thailand. Third, and most importantly, I will bring you into my network of financial professionals looking to hire people just like you. I challenge you to commit 6 weeks to my Valuation Masterclass Bootcamp. Trust me, and I will change your life.